Assalamualaikum. My name is Muhammad Nabil bin Muhammad Adnan. My matric number is 01D8023F1108. So I will start the introduction before we move on the answer session. So this chapter will be explained about the audit planning and audit risk. So audit planning. Audit planning is how the auditor involved in creating a detailed strategy and approach for how the audit will be conducted. Next, audit risk. Audit risk is on how the auditor express an inappropriate their opinion on the financial statement, whether it is correct or not when they actual contain material misstatements. There are three components in the audit risk, which is the inherent risk, control risk, and detection risk. That's all from me. Thank you.
And Assalamualaikum, my name is Nur Ashiki binti Jaha. My matrix number is 01D8023F1086. So today, I would like to explain about question 3. The first part is define the audit risk. What is audit risk? Audit risk is the risk that an auditor will not discover errors or intentional misstatements while reviewing companies' or individuals' financial statements. Audit risk can be defined from two aspects. The first one is the risk of material misstatements in financial statement. The second one is detection risk, which is the risk that an auditor fails to detect a material error or misstatements. That's all from me. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Iman Hazi bin Ismail. My matrix number is 01D8023F1088. Today, I want to present about the part B. That state 5 common conditions that can cause error in financial statement. I can explain with a simple explanation. Okay. First is a lack of knowledge or competence. Error may occur when employer or accountants lack proper training, experience, or understanding of accounting principle or procedure. Two is misinterpretation of accounting standard, incorrect application or misunderstanding of relevant financial reporting framework, such as if IFRS or GAAP, can lead to unintentional mistake. Three is a clerical or computational mistake. Simple mistake such as a data entry error, miscalculation, or incorrect posting of accounts can result in error in the financial record. Four is misunderstanding or miscommunication. Error may arise from unclear communication of interaction, especially between different department or level of management. And last is five is omission of transaction or information. Failure to record certain transaction, whether due to oversight or confusing can cause incomplete or incorrect financial statement. That's all for me, and I can pass for my friend.
Very good day. Today I am going to continue the presentation with the inherent and detection risk. First of all, we will see about the detection risk. Detection risk is the risk that auditors' procedures will fail to detect the material misstatements happened in the financial statement. In a simple term, we can also say that auditors cannot identify or prevent or detect the mistakes in the financial statements. This type of risk closely related to the effectiveness of audit procedures and their application. Detection risk is controlled by the auditor, whereas they cannot find the material misstatements in the financial statement. Today we will see about inherent risk. Inherent risk is the risk of existence of material misstatements in the financial statements before the internal control. It is because the nature of the business. The inherent risk also mentions about the effectiveness of client's internal control. It is also higher for such items such as complex transactions, which is more likely to have more transactions than be planned. That's only from me.
Assalamualaikum, my name is Mu'ala binti Abdul Hakim and my matrix number is 01D80 23F1089. Next component is control risk. Control risk considered to be high where the audit entity does not have adequate internal controls to prevent and detect instances of fraud and error in the financial statements. Besides, financial statements are prepared by individuals who do not have the necessary technical knowledge of accounting and finance. In conclusion, understanding audit risk is essential to ensure accurate and reliable financial statements. By identifying risk types such as detection, inherent, and control risk, auditors can conduct more effective audits and reduce the risk of material misstatements. This contributes to greater transparency and accountability in financial reporting. That's all from us. Thank you.